Hello friends, welcome to learning sessions, and today in this video we will be covering the topic related to the term loan. So kindly please do confirm the audio video quality so that we could proceed. And further, if you're new to our channel, please do subscribe the channel right now and further start preparing for the CAIIB. You can enroll into the courses visiting the website iibf.info, where you'll be getting the full course videos, chapter wise previous question, mock test, case study videos, and the complimentary access to the ePDF notes through our Android application. So do enroll right now. You can also join us on our WhatsApp group. You have to write. You have to WhatsApp us, writing the message CAIIB, mention your name along with it, and WhatsApp it to the number 83609 We will be adding you to the appropriate group over there. So let us start the topic now. It's related to the term loans. So actually, there are two types of the components which can be sanctioned. One, it is in the case of the working capital limit, that is a CC limit which can be sanctioned, and further it is a term loan which can be sanctioned. So in particular video, we'll be covering the term loans over there. So banks provide the term loans normally for acquiring the assets. Whensoever the fixed assets are to be acquired, the term loans are sanctioned. But exceptionally, in the case of working capital, the term loans are also sanctioned. Those are said to be what? Those are said to be the working capital term loans. Those are said to be WCTL, that is a working capital term loans, in which the term loans are sanctioned in the form of the working capital over there, and there is a fixed repayment schedule over which the EMIs or the repayments are to be made. And further, the examples related to the term loans are, like we can say, personal loans, consumption loans, education loan, housing loan. All those are sanctioned in the form of term loans over there. Okay. And particularly related to third point, it says working capital loans are normally sanctioned for 1 year. In case if we do consider from the previous chapter itself, that is from the analysis of the financial statement, I just told you that net working capital is equal to what? It is basically equal to current assets minus the current liabilities. And what was working capital gap? The working capital gap was equal to current assets minus the current liabilities other than bank borrowings. Okay, so that was working capital gap. Now, part of the working capital gap is to be financed from the promoter itself by way of contribution. It can be their margin is to be contributed either from the promoter itself, or it can be contributed from the surplus long-term assets, from the surplus long-term sources, not assets, from surplus long-term sources. Okay, so in case of working capital finance, whensoever the working capital finance is to be done, let us say the CC limit of 500 crore is to be sanctioned. A CC limit of 500 crore is to be sanctioned. Now, a margin is to be basically contributed by the borrower himself or herself. Okay, so in that particular case, if we say the margin is 100 crores, that will be contributed either by contribution of the newer capital, or it will be the case that the 100 crores will be contributed from the long-term funds or long-term sources so available. Okay, so working capital is basically sanctioned for 1 year period because it basically take into account the working capital needs of the firm. That is basically around the working capital cycle over there. But in the case of the term loans, these are payable as per the repayment schedule. It can be a mid-term loan, it can be a long-term loan, it can be a short-term loan. Okay, so for which the loans are to be repaid over the different tenures. So there is no fixed, or we can say there is no uniform repayment schedule for all the term loans. So it may be the case that the one term loan can be having a repayment schedule of 1 year, and the other can be having the repayment schedule of 3 years or 5 years or even more. Okay, so term loan is to be repaid out of the future cash flows of the borrower. That is, a debt service coverage ratio is having a great importance while considering the term loans over there. So whensoever the term loan is to be sanctioned, it is not basically related to that what inflows we are having right now and how we will be paying the repayments. It is basically related to whatsoever the future cash flows we will be having. Based upon that, and from those future cash flows only, the repayments are to be made. Okay, and further, it is related to, I already told you that there is no uniform repayment schedule for all the term loans. Then it is related to the DPG, that is a deferred payment guarantee. Now, what is the guarantee? What is bank guarantee, or simply what is guarantee? So let us take the case that A has purchased the goods from B. But B is not sure about that he will be getting the payment. So he asks the B so as to get him some guarantee from the bank itself. So A visited the bank XYZ, and further analyzing, after appraising the borrower itself, XYZ extended guarantee in the name in favoring person B over here. Now, In case there is default on repayment, in case there is a default of a repayment by person A to person B, in that case XYZ bank will be having the obligation so as to pay the amount. Same is the case with the DPG, but why it is different? But why it is different? Because in case of the capital goods, in case of the capital goods, when the importer or the creditor, when the importer or the debtor, not the creditor, when the importer or debtor, let us take the case that person A is importer over here, who has imported a machinery from B over here, which is a capital good, which is a capital good. So it basically includes, it basically covers a big amount. Okay, so let us take the case the import was amounting rupees 10 crore. It was amounting rupees 10 crore. Now A is not in the position so as to pay rupees 10 crore at an instance, and further a guarantee was extended by XYZ bank to B over here. So token amount was paid by person A to person B. Let us take the case that 2 crore rupees were paid, and further the rest of the amount will be paid by the importer in the installments over there. So that is basically related to, that is related to a deferred payment. That is related to deferred payment, that the amount will not be paid in one hit and will be paid in different repayment schedules and different installments over there. And over there, in this case particularly, the amount will be paid by the importer, but if there is default, the amount will be repaid by the bank itself. So when a purchaser of a fixed assets does not pay the supplier immediately, but pays according to an agreed repayment schedule. So there will be an agreed repayment schedule in between A and B, and as per that, A is to make the payment, and further, if there is default on the part of the importer, on the part of the debtor, in that case, the bank will be having the obligation so as to pay the amount. That is called the DPG. So it is basically non-fund based method. So it is basically non-fund based method. The appraisal of DPG is similar to that of the term loan. Okay, so the appraisal of the DPG is similar to that of the term loan, but in case of DPG, it is a non-fund based method. It is non-fund based method because the bank is having the obligation so as to pay the amount only and only if there is an event related, there is default by the importer. There is default by the importer. Otherwise, the bank will not be paying the amount. Okay. So, however, if purchaser defaults in payment of any amount, the bank has to pay the same to the supplier, and the exposure becomes fund based. Only on crystallization, the exposure will become fund based. Otherwise, it is a non-fund based method. Okay. So the risk involved in case of DPG, because I told you that the appraisal is same as that of the term loan. So the risk involved in the case of the DPG is as the same quantum as that of the term loan over there, and therefore the appraisal is also same. And therefore only the appraisal is also same. Next, it is related to the differences between the term loan appraisal and the project appraisal. Differences between the term loan appraisal and the project appraisal. Now, what is actually the project appraisal? Project appraisal is basically related to that we need to look into that each and every detail of the firm itself related to some particular project. Let us take the case that this particular project is to be financed. In that particular case, it may be the case that the firm required term loan, the firm required CC limit. Now, in that case, CC limit, term loan, both will be sanctioned, and moreover, the margin contribution. I already just told you that whensoever a CC limit is sanctioned, a margin is also to be contributed. So some of the part of the CC working capital will be sanctioned by the bank itself, and some of the part will be contributed by the firm itself. That is said to be margin. Now margin is contributed either by way of new capital, either by way of contribution of the new capital from the investor, from the promoters itself, or it may be the case that the margin will come from the long-term sources. Now, if the margin will come from the long-term sources, in that case, the term loan will be having a additional point to look into. So as to that particular point is also considered in case of project finances, but not in the case of the term loan appraisal. Is that clear? So in project appraisal or in project finance, all financial needs of the enterprise, including the working capital requirement, are appraised. So each and everything will be looked into. Okay, because total requirement of the long-term funds includes a margin requirement too. So as for the long-term funds, we also do require the margin requirement for the CC limit itself. Okay, whereas in the case of the term loan appraisal, that particular aspect is not looked into. So if an existing enterprise want to purchase new machinery, a few new machinery over there, which are not going to have a major impact on the volume composition of the business, it will serve little purpose to have a detailed examination of the techno-economical feasibility, managerial competence, IRR, etc. What does it indicate? That if we are going to start a new business, definitely we need to look into each and every aspect of the company, each and every aspect of the project itself, that whether the project is viable, whether it is having the feasibility, whether the management is competent enough, and all the aspects are must be looked into while sanctioning the loan. But when we are basically, let us take the case where there is a existing firm, who is already working in the field, and that is already viable and already generating the profits, and they want to buy new machinery, in that case it does not require that much detailed examination. Okay, so in that case term loan appraisal will be done, but where full examination is to be done, in that case that is related to the project appraisal. Is that clear? Okay, then it is related to the project appraisal. Let us have a look at the different aspects that must be looked into. So it is related to the appraisal of managerial aspects, technical appraisal, economic appraisal. So first of all, it is related to appraisal of managerial aspect. So we'll be looking into the aspect that whether the management is competent or not. So whether the what are the credentials of the promoters, financial stake of the promoters in the project itself, that is what is their contribution, related to can they bring additional funds in case of contingency. What is a contingency? Contingency is an event which actually if occurred, that can cause an issue. That if there is a contingency, if we require some additional capital, would the promoter would be in a position over there so as to contribute an additional capital over there. So that is related to that, and that particular factor must also be looked into. Then it is related to what is the form of business organization, who are the key person, who are the important crucial persons over there so as to run the business over there. That is the appraisal of the managerial aspect. Secondary, it is related to technical appraisal. Now what is technical appraisal? Technical appraisal is basically related to, we need to look into the viability of the project, that whether the project is feasible over there or not, related to what is the location of the project, what are the products which are going to be manufactured, what is the availability of infrastructure, is raw material available, is skilled employee available, contractor for project execution, waste disposal, pollution control, each and every factor related to what is technically required so as for the viability of the project, that is the technical appraisal. Okay, the third one, it is related to the economic appraisal. Economic appraisal is related to if project is viable, everything is going fine, is the project workable, are we going to generate the profits out of it, what is the return on investment, what would be the break even analysis. What is break even analysis? Let us take the case that product is costing us ₹5, and further we have already produced 1000 products. But when the and our selling price is ₹10, let us take the case that we have sold 500 units, or we can say, so what will be the total cost associated with it? So it is 5,000 rupees. The total cost associated with that is a total cost to us, that is ₹5,000, and we are selling it for ₹10. So there were 1000 units which are available, and we have basically produced 1000 units for, and further that cost us ₹5 for 1 unit. Let us take the case that we are selling 1 unit for ₹10, and we sold 500 units. Now at that particular stage, it will be the condition of no profit, no loss, and that is said to be what? That is said to be the break even analysis. A project with high break even point is considered riskier. Because if the break even point is higher, in that particular case you will be able to cover all the cost at a later stage. But if the break even point is lower, you will be able to cover all the cost at an earlier stage. Okay, so that is why break even analysis is also required. The third one, it is related to the sensitivity analysis. Now what is sensitivity analysis? It is related to the market condition. Market is not going to be the same now. It may be the case that there is some event occurred, and further it may be also be the case that the product you are going to manufacture, it may become obsolete in the market itself. So each and everything must be looked into, that if there are some factorial change, how your project will be working along with those conditions. Okay, so sensitivity analysis examines such impacts. It may be the case there may be the change in the prices of the raw material. It may be the case there is some conditional change, there may be some legal imposition. So each and everything must be looked into. That is the economic appraisal, and further particularly related to the sensitivity analysis. Okay. So the three type of appraisal is to be done. One, it was related to the managerial appraisal. Second, it is related to the technical appraisal. Third, it is economic appraisal. Further, it is related to appraisal and financing of infrastructure projects. Now, infrastructure basically includes what? It includes the roads, bridges, power, transport, telecommunication, hospitals, etc. And this is defined in Section 10 of the Income Tax Act. This is defined as per Section 10 of the Income Tax Act. Now, there are some of the distinct features related to the infrastructure projects. What are those? First of all, in that particular case, these are having exceptionally long implementation period. Exceptionally long implementation period. If you're going to construct a house in 1 year, it may be the case that it will take around 5 to 7 years or even 10 years. So as for the construction of the roads, bridges, etc., and longer gestation period is required, payback period will be more, because whatsoever you are going to invest, it will be the case that you will be getting back the same amount in a longer term, in a very longer term. And also high debt equity ratio, because in case of the infrastructure project, when you're going to invest in the infrastructure projects, it may be the case that you are having own funds equal to rupees 100 crore, but you're going to take a debt from the market itself amounting 1500 crore. Now in that case, particularly, debt equity ratio is exceptionally high. It is exceptionally high, but that is allowed, and that is a distinct feature of the infrastructure project itself. Okay. And there are some guidelines by the Reserve Bank of India. Let us have a look at it. So first of all, it is related to types of financing by banks. Types of financing by banks. First of all, it is related to takeout financing. Takeout financing. Now, what is takeout financing? Takeout financing is a position where a loan will be first of all sanctioned by the bank. So let us take the case that bank has sanctioned a infrastructure loan to the ABC Limited amounting 10,000 crores. Let us take the case 10,000 crore amount of the loan was sanctioned by the bank beforehand, and further at a later stage, when the bank was in need of liquidity, in that case, the bank had already an arrangement with the IDFC. That is Infrastructure Development Finance Company, and further the bank sold the loan to the IDFC. Or basically it just took out its liquidity from the loan, and further it was transferred to the IDFC. Now that is basically related to what? It is related to the takeout financing. Secondary, it is related to the inter-institutional guarantee. Banks are permitted to issue guarantees favoring other lending institutions in respect of infrastructure loans. What does it indicate? So ABC Limited firm over here, it basically approached bank XYZ so as for the sanction of the loan. Where the another bank, let us take the case PQR Bank, gave a guarantee in favor of XYZ for ABC Limited. That is actually allowed. That is basically inter-institutional guarantee. Now there is also an exposure on PQR itself, because it has extended a bank guarantee. Favoring ABC in name of the favoring XYZ in name of the ABC Limited. Okay. And that particular case, the guideline says that at least 5% extent of the project cost must be the funded share of the guaranteeing bank. Okay, so 5% of the total project cost. Let us take the case that the total project cost was 500 crores. Now at least 5% of 500 crores, that is equal to 5% of 500 crore is equal to 25 crore. That must be the funded share by the PQR bank itself in the project cost itself. That the margin, it must be the, not the margin actually, this must be the contribution. This must be the minimum contribution by the PQR bank into the project cost over there. Is that clear? Okay. And also it must be undertaking the normal credit appraisal, monitoring, follow up the project itself. Okay. Third, it is related to the financing promoters equity. financing the promoter's equity. So banks were advised that the promoter's contribution toward the equity capital of a company should come from their own resources. So here is a scenario. Let us take the case that ABC Limited is the infrastructure company and X is the promoter of the company. X is the promoter of the company who wants to contribute in the equity of the company. He wants to actually invest into the company ABC Limited over here. So for that particular purpose, he wants to own the shares of the ABC Limited company. Now, for that particular purpose, it was not allowed to the bank itself that they cannot finance for so as to purchase the shares of the other company. Okay, so banks were advised that the promoter's contribution towards the equity capital of the company should come from the X own resources over there, and banks normally do not grant the advances to take up the shares of the other companies. But looking at the importance attached to the infrastructure itself, it was basically decided that under some specific certain circumstances, an exception may be allowed where the banks can basically extend an advance to the X over there so as to contribute into the equity of the ABC Limited over there. So indirectly, the bank is going to advance the infrastructure company over there. Is that particular part clear over here? Now, what are those conditions? Let us have a look at it. First of all, it says the bank financed would be only for acquisition of the shares of existing company. So it will be basically acquisition of the shares of the existing company only, not for the new company which are providing the infrastructure facilities. Secondly, it says acquisition of such shares should be in respect of the companies where existing foreign promoters voluntarily propose to disinvest their majority shares in compliance with the SEBI guidelines where applicable. So there were previously the foreign investors who want to disinvest their shares, and that was basically compliance, having the compliance with the SEBI guidelines, that is the Securities Exchange Board of India guidelines over there. Because whensoever the amount is to be a major amount is to be disinvested from the company itself, that is also as per the SEBI compliance, that were also as per the SEBI compliance. So if that particular scenario is there, in that case the bank can advance to the X over there so as to contribute to the equity of the company itself. Further, it says the companies to which the loans are extended should be having a satisfactory net worth. So over here, the company X must be having a satisfactory net worth, and it should not be defaulter of the banks or financial institutions. Bank finance must be restricted. It must be restricted to 50% of the finance required. So whatsoever the finance is required, it is restricted to the 50%. 50% would be the X company contribution itself. Okay. So these are the conditions. And the sixth one, it says that the finance extended should be against the security of the assets. So whatsoever the finance is basically extended, it must be against the security of the assets. The shares so purchased by way of the finance should not be taken as a security. Those can be taken as a collateral security, but the primary security must be related to the assets of the company X. It must be the assets of the company X, and the secondary security can be taken as the shares of the company so acquired. Okay. So that is related to it. And the eighth one, it says banks should ensure maintenance of stipulated margin. So whatsoever the stipulated margin, I already told you that 50% margins to be maintained. That is basically, that must be ensured. The tenure of the bank loans may not be longer than 7 years. So the whatsoever the loan is extended to the X over here, that must not be having a repayment period longer than 7 years. But after the board of directors decision, if it is required, so where the project financial viability of the project requires, so in that case the longer period can also be allowed. Further, it says the financing would be subject to compliance. With statutory requirements. So what's the statutory requirement over there? It says that the bank's total exposure, whether as a pledgee, mortgagee, owner in any other company, should not be greater than 30%. Of the paid up capital of that company, or paid up capital plus reserves of its own, whichever is lower. Okay, so that is a statutory requirement that must also be fulfilled. And the 11th point, it says that the bank financing acquisition of equity shares by the promoters should be within the regulatory ceiling of 25%, because there is an exposure norms on the bank itself, that is to the total net worth. to the total net worth of the company, it should not be exceeding 25%. The total capital market exposure should not be exceeding 25%. That is also to be fulfilled. Okay, and further, the proposal for bank finance should have the approval of the board. It must be having the approval of the board itself. So these are the guidelines. Let me just reiterate those what were the guidelines. First of all, it is related to the that the acquisition of the existing shares for only that can be issued, and further a charge is to be created on the assets of the borrowing company. The borrowing company must not be defaulter, and further it must be the case that the major investors in the ABC limited company, that is the infrastructure company, must have disinvested as per the compliance of the SEBI itself. And further, the companies to which the loans are extended should be having a satisfactory net worth, not defaulter. 50% margin is to be maintained, and it must be ensured that the margin is maintained at each and every stage. And further, I just told you that is related to the tenure of the bank loan should not be exceeding 7 years. It can do exceed 7 years in case it is as per the viability of the project, and approval from the board of directors must be taken. Okay, so these were the conditions we have read so far. So next point, it is related to the appraisal. So in respect of financing infrastructure projects undertaken by the government owned entities, financial institutions should take due diligence on the viability of the projects. So first point, it says that the viability of the projects must be ensured. Secondary, it is related to banks must ensure that the individual components of financing and returns on the projects are well defined and well assessed. So we must be looking at the return on investment. And for the state government guarantees may not be taken as a substitute for the satisfactory credit appraisal, because in case of state government guarantee, normal IRAC norms are applicable, whereas in the case that the loan is guaranteed by the central government, the IRAC norms are not applicable over there. The loan account remains to be standard even if there is no repayment, if it is guaranteed by the central government. Okay. Further, infrastructure projects are often financed through the special purpose vehicle. Now, for that particular purpose vehicle, what is actually SPV? A special purpose vehicle is created which will be looking into each and every aspect of the project. So financing of these projects would therefore call for special appraisal skills on part of the lending agencies. So if the bank is to finance the infrastructure loan to the infrastructure company over there, for that particular purpose SPV will be created, which will be handling each and every minute details and will be looking into the viability of the project and whatsoever the returns on the project itself. And further, based upon that, the loan will be sanctioned, and for that particular purpose it do require the special skills associated with the same. And further, it is related to identification of the various project risks. So whatsoever the different project risks are associated with the project, those must be looked into, and as per that the premium or of the interest must be charged to it. And for the evaluation of the risk mitigation through appraisal of the project contracts, it must also be looked into. Next point, it says, in this connection, banks or financial institutions may consider constituting appropriate screening committees. So screening committee must be there who will be basically appraising the credit proposal. So because I just told you that the appraisal of such kind of projects do require special skills, so there must be special cells or special screening committees which will be appraising the project itself, will be monitoring the progress or performance of the project. Okay, and then it is related to the size of the funding requirement. So if the exposure is larger enough, in that case individual bank will not be sanctioning the loan, and it may be the case of the consortium or the syndication arrangement. Then it is a case, in such cases, participating banks or FIs, for the purpose of their own assessment, refer to the appraisal report prepared by the lead bank or FI, or have to the appraisal jointly. So what does it indicate? So I just told you that if a infrastructure loan is to be sanctioned, because it basically do include higher quantum of the loans, in that case particularly the loan may not be sanctioned by the individual bank, and it may be the case that a multiple banking arrangement is there, or syndication of the loan is there, or we can say consortium lending is there, where multiple banks are basically sanctioning the loan to the infrastructure company or for the infrastructure purposes over there. In that case, In that case, it may be the case that the appraisal report may be prepared by the lead bank or the financial institution over there, and other banks can refer to it, or it may be the case that all the banks will be jointly appraising the project itself. Okay, so that is the appraisal part. Then it is related to the prudential requirements. The next one, it is related to the prudential requirements. So the prudential requirement, first of all, it says prudential credit exposure limits, and the I just told you that the bank's overall exposure to the group should not be exceeding 25%. So the group exposure should not be exceeding 25% of the bank's capital funds, or we can say bank's net worth. And further, credit exposure to the single borrower may exceed the exposure norms of 15% of the bank's capital fund by additional 5%, and provided additional credit exposure is on account of the infrastructure. To the group person, the exposure should not be exceeding 25%, and if the exposure is to the individual, in that case it is basically maximum up to 15%, which can be exceeded by 5% by the permission approval from the board of directors, and further can be increased to 5% in case of the infrastructure projects. And further, in addition to the exposures permitted above, banks must be having an exceptional circumstances. I just already have guided you accordingly that in that case 5% extra exposure can be there if the approval is from the board of directors. Okay, further it is related to the banks should make appropriate disclosures related to the different exposures. So if a bank is having the net worth of amounting 1000 crores, in that particular case, the maximum loan amount that can be sanctioned by the bank to a single group, that is basically limited to 25%, that is 250 crores. And to the individual itself, it is basically limited to 150 crore, which can be extended another 50 crore by the approval of the board of directors. Okay, and the bank must be making appropriate disclosures in that particular regard. Second, it is related to assignment of risk weight for capital adequacy purposes. Now just you are already aware that the banks must be adhering to the Basel norms. And as per the pillar 1, the banks need to maintain the minimum CAR. The banks need to maintain the minimum CAR or CARAR, that is capital risk weight asset ratio, that must be maintained. And further, a risk weightage must be assigned to the loans. So banks are required to be guided by the prudential guidelines on capital adequacy and the market discipline. And further, for the capital adequacy purposes, the risk weightage must be assigned. It can be based upon the standardized approach, under which for the different products the risk weightage percentage is provided by the Reserve Bank of India, or it may be the case the Reserve Bank of India has also allowed the rating agencies so as to rate the counterparties. So if counterparties are being rated by the rating agencies, that is also admissible, and the risk weightage percentage can also be ascertained by that particular manner. Okay, then it is related to the asset liability management. Because in case of infrastructure lending, it is not the case that the banks are lending a large amount for 1 year or 2 years. The infrastructure loans can be there for 25 years or 30 years. Okay, so in that particular case, the bank may basically suffer the illiquidity. And that must be managed, because the banks are to manage the asset and the liability outflows and inflows. So assets are basically, in case of assets, you will be basically receiving the repayments. Assets are basically the loans that the banks have extended, and further there will be inflows. And in case of liabilities, when the liabilities will be maturing, there will be outflows. So in case of maturing assets or on the scheduled repayments, you will be basically receiving the amounts, so it will be inflows. And for the in case of the maturing liabilities, it will be related to outflows. When an FDR is matured, you are to pay the amount. That is an obligation on the bank now. So that must be managed. So for a particular time horizon, let us say the case for window for 2 to 7 days. Let us take the case that the maturing assets, that the repayments that you will be receiving are amounting 100 crores. and the liabilities that are going to be mature, that is related to the outflows, that is basically 200 crores. Now in that case particularly, there is a negative gap because you're going to receive only 100 crore, but you are having obligations as to pay 200 crores. So there is a negative gap, and that must be looked into because it's a serious concern. Otherwise the bank either has to basically borrow the amount from the market so as to fulfill its obligation, or the bank will be basically announced insolvent. Okay, so those are the cases. So bank need to exercise due vigil on their asset liability positions so as to ensure that they do not run into the liquidity mismatch. So this condition was basically related to the liquidity mismatch. So bank must be avoiding such type of situations over there. Next, it is related to the administrative arrangement. Next, it is related to the administrative arrangements. So timely and adequate availability of the credit is a prerequisite for the successful implementation of the infrastructure project. So whensoever the project is appraised, it must be considered particularly whensoever the funds are required, how much funds are required, because the funds must be available in time and funds must be available adequately too, because those are the two parameters related to the successful implementation of the infrastructure projects. So clearly prescribe the procedure for approval of the loan procedures. So that must be clearly prescribed. There must be a special cell or department related to that, which will be appraising the proposal, which will be monitoring the proposal itself, and that is particularly required. Okay. Further, delays are to be avoided. The banks must be setting up a mechanism for an ongoing monitoring of the project itself. Next, it is related to the takeout financing or liquidity support. So just give a gist related to takeout financing. Let us have a look at it. So takeout financing structure is essentially a mechanism designed to enable the banks to avoid asset liability maturity mismatches, because I just told you that the infrastructure loans are sanctioned for a longer duration. So now you are having the liabilities. Let us take the case that you are having the deposits with you, that is the liabilities with you for a period of 5 years, and that deposits are amounting 500 crores. Those deposits are amounting 500 crores. Now based on these deposits, which are going to be there with you for next 5 years, you sanctioned an infrastructure loan amounting 400 crores. That is your asset, and the duration of this infrastructure loan is 20 years. It is 20 years. Now there is maturity mismatch. Because your liabilities are going to be mature after 5 years, whereas in case of your asset, that will be repaid you after 20 years. So as to basically avoid the asset liability maturity mismatches that may arise in the case of the infrastructure projects, so takeout financing is basically being adopted by the banks. Okay, so under this arrangement, banks financing the infrastructure projects will be having an arrangement with the IDFC or any other institution. So let me give an example that XYZ bank is over here, which is already having an arrangement with the IDFC bank or any other institution, financial institution, or the bank over there. And for the whensoever the liquidity will be required by the bank, because XYZ bank has extended infrastructure loan to the ABC firm over here. And further, let us take the case that it is basically in a tight liquidity situation and XYZ bank requires a liquidity. So as per the previous arrangement sanctioned, the bank will be transferring the balance outstanding in their books. The bank will be transferring the balance outstanding in the books at a predetermined basis. Is that clear? Now XYZ bank will be receiving the liquidity. The infrastructure company has already received the funds over there, and IDFC will be handling the other things, because at that particular time IDFC will be helping the bank over there so as to provide the liquidity. Okay, so that is basically related to the takeout financing arrangement. Next, it is a liquidity support from IDFC. So as an alternative to the takeout financing, structure, IDFC and SBI have devised a product providing liquidity support to the bank. So under this scheme particularly, IDFC would commit at point of sanction to refinance the entire loan, so as to refinance the entire outstanding loan. Or it may be the case that a part of the loan will be basically refinanced by the bank as per the agreed terms. Now, in previous case, that in the case of the takeout finance, in case of the takeout finance, the full finance along with the risk was basically transferred by the bank XYZ to the IDFC over there. But in case of liquidity support, there will be a predetermined arrangement as per that the IDFC will be providing only and only the liquidity facility. The risk will remain with the bank itself. And IDFC will be providing the liquidity facility only. Okay. So that is related to the liquidity support and the takeout financing. So that would be all related to this particular video. I hope that you must have learned the content related to it. So kindly please do rate the video at the earliest. And if you want to join us, do visit the website right now and further start preparing for the CAIIB. You will be getting the full course videos, chapter-wise previous question, case study videos, mock test, and the complimentary access to the ePDF notes through our Android application. And if you want to join us on our WhatsApp group, do WhatsApp us writing your name, mention CAIIB along with it, and WhatsApp it to the number 83609444207. We will be adding you to the appropriate group over there. So thank you so much and see you again in the next video.